Why do people buy and sell parts of companies? And somehow that affects the economy and even your future. This is the world of the stock market, and to understand how it works, we need to go back in time. Hundreds of years ago, before smartphones and skyscrapers, trade was done face to face. Farmers sold crops, blacksmiths sold tools. But as ships started sailing across oceans in the 1600s, something changed. These voyages were expensive and risky. So in the Netherlands, merchants came up with an idea. What if lots of people shared the cost of one ship and also shared the profits or losses? This is how the first shares were born. The Dutch East India Company became the first company in history to sell stock, tiny pieces of ownership to the public. Investors bought shares, hoping the ship would return with valuable goods. If it did, they made money. If it sank, they lost. And just like that, the first stock market was born in Amsterdam. So, what is a stock? A stock is a share of a company. When a company wants to grow, it can ask for help by selling shares. People who buy those shares become partial owners. If the company does well, the value of those shares goes up. If it does badly, the value goes down. But how do people know what a stock is worth? That's where the stock market comes in. It's not a single place. It's a system. It's where stocks are bought and sold every day, kind of like a giant auction. People are constantly buying and selling, setting prices based on what they think will happen in the future. If a company is building exciting new technology, people might rush to buy its stock, pushing the price up. If bad news comes out, like a poor earnings report or an economic crisis, people might sell and the price drops. This constant buying and selling is what makes the market move every second.